For those of you who may not be familiar, the NPDA supports franchised and independent powersports dealers through education, advocacy, programs, and practical resources, all focused on helping dealers build a stronger, more professional, and more profitable industry. This partner webinar series gives dealers direct access to the companies, tools, and people helping shape the powersports retail landscape with one goal in mind: keeping dealers informed and exposed to ideas they can actually put to work. Today's webinar focuses on one of the most important profit opportunities in a dealership, F&I. For many dealers, F&I is viewed mainly as something that happens at the end of the deal, but when it is structured correctly, it can become much more than a single deal revenue source. It can become part of a dealership's long-term wealth strategy. That is what today's conversation is about, going beyond the sale. Programs like reinsurance, retro arrangements, and other F&I profit participation structures can give dealers the opportunity to participate in the performance of the products they sell. Done correctly, that can support longer-term planning, more stable revenue, and a better financial foundation for the dealership. But there is no magic button. Dealers need to understand the structure, the risk, the capital requirements, the timing, the upside, and whether a particular program actually fits their store. We're joined today by Tad Horst from Protective Life. Tad works directly in the F&I and dealer profit participation space, helping dealers better understand how these programs are structured, how they work, and how they can fit into a broader dealership strategy. Today, we'll take a practical, dealer-focused look at F&I profit participation, including reinsurance and retro options, what dealers should understand before getting involved, what questions they should be asking, and how these programs can potentially help build long-term dealership wealth. Please drop your questions or comments in the Q&A. We'll work as we go through this webinar to incorporate those into the presentation. And if not, we'll take some time at the end of the presentation to work through whatever didn't get answered. You'll find that Q&A button down in the Zoom toolbar at the bottom of your screen. This webinar is being recorded, and the recording and presentation will be made available afterward. And with that, I'll turn it over to Tad.
Excellent. Thanks, Mark. So as Mark noted, I am Tad Horst. I'm with Protective. I'm in the wealth building department there as a client program advisor. And what we want to do today was give you a fairly broad overview of what profit participation is and the two most common structures that you'll see. The information you'll see isn't specific to Protective, but rather, like I said, an overarching overall how these programs work and such. First of all, what are the profit participation programs and how do they benefit you, the dealer? So Powersports dealerships profit participation programs enable dealers to share in the underwriting profits and the investment income generated from F&I products they sell, such as service contracts, gap coverage, and other ancillary products. These programs, including reinsurance and retros, can help stabilize revenue, offer meaningful tax advantages, and support long-term wealth creation beyond the initial sale. And we'll go into each of those and talk about the specifics there. But in general, sometimes I'll get a question on why would a provider have these programs? Because essentially we are giving away all or a portion of the underwriting profit that we make on the contracts, as well as the investment income. So what's in it for us? Why would a provider do this? The biggest part of it is simply the relationship with the dealer, and with that, the retention and the growth of the business. So if the dealer is in one of these programs, and there's potential for up to significant profits there, obviously there's going to be more of an incentive to continue to write with us and to grow the business, add additional products to those programs when possible. Another one that not everybody thinks of is with the loss control. So when we look at loss ratios, if a dealer is in a participation program, generally the loss ratio is going to be lower on that book of business. So if we look at these programs versus a dealer who does a walkaway program, writes direct, does not participate, there is quite a difference in the loss ratio there. And when you think about it, it makes complete sense. You know, if you have some skin in the game, you might be a little more careful with the claims and such.
Hey, Tad.
Mark? Yep.
Will you go ahead and reshare your presentation? So we lost that when we flipped on.
Oh, okay.
Thanks for the reminder from the crowd.
Thank you. Yeah, we would have had no clue. There we go. Excellent. Good. Okay. And thankfully, we weren't too far into it. So the other screen that we'd shared was simply exactly what I had read off earlier about the participation programs and why a dealer would want to do this. And then here we are where we're talking about what's in it for us. Why would we do this? So as I talked, the loss ratio generally is in a better position, therefore ultimately less risk to the provider of the insurance company there. And also, we talk about golden handcuffs. This is especially true with retro programs. Retro programs often will have a clause in the agreement where you must continue to write to receive the retro payments. So again, you got those handcuffs of potentially, if you leave that provider, you could possibly be leaving the retro behind also. With that, we'll talk about the two programs that we're really going to focus on. And these are by far the most common, especially when it comes to the Powersports arena. But those are reinsurance and retros. Reinsurance, basically there could be two different kinds of programs that you'll want to keep in mind. And those are admin obligor and dealer obligor. What that means essentially is the obligor is who's obligated to ultimately pay the claims. So when it's an admin obligor, the insurance company, in my case it would be Protective, would ultimately be responsible for paying all claims. The other scenario is a dealer obligor, and they're ultimately the dealer could be obligated to pay claims there, and I'll go into that in a little more detail. But with that, let's talk about reinsurance. Not going to go into all the different IRS rules and different things there, but essentially a reinsurance company is a reinsurance company. So whether you have reinsurance with company A or company B, really the underlying company is going to be exactly the same. So with that, with most reinsurance ventures, 100% of the underwriting and investment income is part of the reinsurance company. Underwriting income is simply we set aside this much in reserves to pay claims, and we paid out this much in reserves or in claims. So the difference being your underwriting profit there. Investment income can be significant. Typically, what you're doing there is you sell a contract, say that's for 4 years. The premium in that contract is going to be spread out over 4 years to pay the claims. So much of that money is sitting in there year after year as it earns out over those 4 years. So that's where the investment income can come in. So the dealer will put these funds into a custodial account, a trust account, and earn investment income on that over time. One of the huge benefits of reinsurance is the taxation. So when you set up a reinsurance company, you'll make an election with the IRS where you say, treat me as a small casualty insurance company. And what that means is as long as you qualify, and I'll talk a little bit about that coming up here in terms of your written premium per year, you're only taxed on your investment income as the company goes along. So every quarter, generally the company who's managing your account will pay the IRS their portion of the investment income that you would earn during that quarter. But that's coming directly out of the reinsurance company. The dealer's not cutting the check or paying that in any way. Another big tax advantage is when you do take surplus funds, when you take profits out of a reinsurance company, they are taxed at the capital gains rate. So obviously a bit of a difference there as opposed to if it was ordinary income. So there are definitely tax advantages there. Another way that a lot of dealers are using reinsurance these days is with loans. So you don't need to necessarily take out your surplus funds. That it's not the only way of accessing them. You can also take a loan against those surplus funds. So you would actually be paying your own reinsurance company back for that loan. And as long as you're paying back the loan, there's nothing taxable happening there because it wasn't considered a distribution. There are some companies out there that will also consider letting you loan against the unearned reserves. So not only the surplus that is already built up on the contracts that are earning out, but also potentially the unearned reserves. One thing to keep in mind with a reinsurance company is it's not connected directly to any provider. So when you form a reinsurance company, you might be writing with Protective. You could also be writing with another company into that same exact reinsurance company. And how that works is there would be separate bank accounts within there, so everything is siloed so that you don't have intermingling of the insurance funds. But it's all under the umbrella of the one reinsurance company. And when I call it portable, what that means is simply if you stop writing with a certain provider, they have no access to those funds, to those reserves. It's your reinsurance company. That book of business would simply go into runoff then and continue to earn out over time. So you don't have those the tieback like you do possibly with a retro, where when you stop writing, that could be they can cease. Reinsurance company would continue to go forward. One of the big advantages also to reinsurance is that you control when you're going to take funds out, whether it's as a distribution, as a loan, or if you're going to sweep it over to an investment account. You decide when to do that. So you're not on anybody else's timetable where, a retro, you qualified for a payment. Here's a check, once a year, twice a year, whether you want it or not. Reinsurance, from one day to the next, again, you decide what you're doing with those surplus funds, if anything. And then at the bottom, I already hit upon, if you stop writing with a provider, those contracts just continue to earn out, and you continue to earn the profits there. So those are some of the big pros when it comes to reinsurance. Some of the cons, these aren't necessarily very negative items, but they are just trying to show you the difference between reinsurance and a retro. So with a reinsurance company, you would actually have to form a company. So you would work with an attorney, work with the provider, and they would walk you through the steps of forming your company. Varies how much that's going to cost, but there is generally going to be a cost associated with that for the formation of the company and then the capitalization of the actual account when you start off. With Protective, it's $5,000 for all of that. But again, that can vary significantly with other companies out there. One of the other things we need to think about with reinsurance is there is a limit in how much reserves you can put into that company per year. And that's under that IRS rule that we talked about a little bit earlier, where if you get taxed only on your investment income. Well, the IRS has within those rules a limit of your written reserves per year, your written premium. Currently, it's 2.9 million, and it goes up each year depending on the inflation rate. What that means is as long as you're under 2.9 million per year in written premium, you're only taxed on the investment income. If you go over that in a year, now you're taxed on your underwriting profit, which can be, many cases, quite a large bill compared to just on the investment income. But to give you a feel, with typical reserves for a Powersports, for a VSC on a motorcycle, we're talking thousands and thousands and thousands of contracts before we would even have to worry about getting close to that 2.9 million. There are fees associated with running your reinsurance company. Those aren't necessarily fees going to Protective or any other provider. but you are renewing your license each year, where that might be in Turks and Caicos or with the Delaware Tribe. You're filing your tax return, producing financial statements. So basically, the attorneys and the accountants are involved. And those annual expenses, again, vary quite a bit by the different providers, but we're generally looking in the $5,000 to $10,000 range per year. And as with paying the taxes, that those expenses are paid directly out of the reinsurance company. So in other words, the dealers shouldn't need to write a check for those annual operating expenses or renewing the license. I mentioned Turks and Caicos. There are some dealers that, as soon as they hear offshore, become a little apprehensive. Simply, we all have the connotation of offshore and that there's something shady going on. I can tell you these companies traditionally in Turks and Caicos have been around for many, many decades and been tested. And the most important thing, too, is the IRS is very well aware of all these companies, because when you form the company, you actually file with the IRS to say, I have this company in Turks and Caicos, treat me as a U.S. taxpayer. So there's nothing shady. I can certainly tell you that. But again, some dealers will have that connotation of an offshore company. I mentioned there are alternatives available. Over the last number of years, quite a few of these reinsurance companies are being set up with the Delaware Tribe. So it's a sovereign nation within Kansas, to where you can form your reinsurance company with them. So it's offshore but onshore. Another thing to keep in mind with a reinsurance company is it can take some time before you'll see profits in this. So don't necessarily go into a reinsurance position thinking 6 months from now I'm going to be taking loans and taking distributions and this kind of thing. It does take time for the surplus to build up in those companies, depending on the length of the contracts that you're putting into there. If you're selling short-term contracts, you're going to see a surplus earlier. Longer-term contracts, it's going to push it a bit further out. And possibly, and this one I should have an asterisk with, in that if there is an underwriting deficit, the reinsurance company could be required to infuse additional capital to cover the required reserve. So at any time, there's going to be a certain amount that needs to be kept in the reinsurance account to pay all the future claims with insurance regulations and in the agreement that you have with the provider. And if you fall below that reserve requirement, you're going to have a deficit. And technically, you could be required to, if you want to keep the company going, to bring that deficit up. I say technically because at the end of the day, this being an admin obligor company, ultimately the insurance company who's writing those contracts is the one responsible for paying all those claims. So if things go terribly wrong, loss ratio is well above where it needs to be, and it's just not coming down, ultimately the dealer can walk away, and all those claims would continue to be paid by the claim provider, the insurance company behind those. Now, I'll talk briefly about the reinsurance, but dealer obligor. I'll keep it brief because honestly, dealer obligor, it's pretty rare, but I do want to talk about it just so everybody's aware of it. If you have anyone come in and talk about, this will be your own company and such, well, to kind of give you some background on that. First, the pros are it's just like a regular reinsurance company with an admin obligor, in that 100% of the underwriting and the investment income goes to the reinsurance company. One other thing about this is because it's the dealer's contract, truly the dealer's contract, there's some flexibility there to set rates and claim reimbursement levels. And you can also require within the contract that all service be done at the selling dealership or a dealership within the group. So those are obviously positive items there. But with a dealer obligor, let's biggest thing to keep in mind is, as the name implies, the dealer is the obligor. The dealer is the one who is required to pay the claims. So there potentially there could be the assets of the dealership can be at risk if claims and lawsuits exceed the reserves. Keeping in mind, most of these contracts are going to have clips with an insurance provider to protect against that. But it is truly the dealer is the obligor here when it comes to the unearned reserves showing up as a liability on the dealership financials. That's important. If the dealership's going out to a bank to get a loan and they ask to see the financials, there's going to be a liability on there for that unearned premium to pay those future claims. And also, because the way it's set up with the IRS is the taxation benefits that you have with an admin obligor reinsurance company, you lose some of those with this one. So it's a difference in the way the accounting is done essentially, and therefore it's taxed as dealer income rather than as capital gains.
Hey, Tad.
And then, yes, sir.
Is there a reason why somebody would choose this option over the other?
So you generally have higher access to the funds, so you're not necessarily waiting those 2 or 3 years before you're seeing profits. Depending on how it's set up, you can, because that's your company. You do have access to the unearned premium there. So a lot of dealers like that there is access to additional cash there, but at the same time, eventually claims have to be paid. So you need to be sure the funds are available in the future to be able to pay those claims.
Seems like it would also add another layer of complexity were the dealership to want to sell at any point in the future.
Yeah, very much. We see that fairly often where a dealership will be in this program and not even realize that there was this connection, and they'll come to a different company and say, "Can you buy me out of this? Can we do something here so I can sell the dealership?" But yep, absolutely is going to be a liability against there. But ultimately, like I said, these are pretty rare. But I did want to mention it just in case anyone ever walks into the dealership and starts talking about this program where the dealer is the obligor, that you at least know what questions to ask before getting into that.
Thank you.
Sure. Now with a retro, it's a little simpler in that with a retro, it's not like the reinsurance company where you're forming the company in Turks and Caicos or the Delaware tribe, and you're have your annual taxes and financials. It's much more hands off, and there's no formation of the company. So literally you sign a retro agreement and you're done. So there's nothing to set up there, nothing to continue to pay to keep going forward. There is no risk. So with a retro, if your loss ratio is high and you have underwriting losses, that simply means that you just don't receive a payment for that period. But you are not going to be, they're never going to come to you to try to collect that money. Most of the programs out there do not have what's called a clawback. So let's say you were paid $100,000 last year. Now this year, the loss ratio has gone up, and suddenly we're at a deficit of $20,000. The vast majority of the retros out there have no way of collecting back anything they've already paid out to you. But definitely read through the agreement, make sure that's not the case in there. But some of the cons, I'd say, to a retro would be that control. So I mentioned with a reinsurance company that you decide when to do a dividend, when to move funds to an investment account. There we go. So, or when to take out a loan there. With a retro, you're told, here's your payment, and you receive a check, or those funds are wired to you. Generally, with a retro, this goes back to those golden handcuffs. There are writing requirements to qualify for a payment. So within a typical retro, it's going to tell you you must write X number of contracts per year, per month, per 6 months, whatever it might be, to continue to qualify for those retro payments. You also want to watch the language in those agreements to see if there's any vesting. In other words, if you're in a retro for a number of years and stop writing, do you still continue then to be paid? And if so, how do those payments continue? Or do they immediately stop as soon as you no longer hit the qualifying volume? One of the big tax differences here is the distributions that are made from a retro are taxed as ordinary income. So if they're going to an individual, it would truly be ordinary income. A lot of dealers will have the retro payments made to the dealership, so that it's just part of the dealer's taxes. But you don't get the automatic capital gains rate that you do with reinsurance. You also want to look to see what fees are being applied to a retro. So at a retro, you sell a contract that has, within the cost of the contract, there's say $1,000 in reserves in premium. With reinsurance, that full $1,000 should be going over to your reinsurance company. With a retro, it might not be the entire amount. There may be what are called retention fees, where a certain percentage or dollar amount is kept from that. Or there are some providers out there that will charge a higher admin fee on a retro than they would on reinsurance or any other program. And the reason behind both those is, again, there's no downside for the dealer, so all the risk is on the provider there, the insurance company. And then the last thing I have on the cons for retro is there's a potentially less investment income. So with a reinsurance company, you're allowed to invest all those funds that are sitting there to pay claims over the years. You're allowed to invest those in certain ways. And that, again, varies by the provider. But let's say typically 20% of all those funds can be in equities, the other 80% in securities. If this were a retro, generally there is no separate bank account where the dealer's controlling any of those investments. So often a retro will just not even pay investment income. It's purely underwriting profit. Or they can have a set rate. For instance, with protectives, we pay the 90-day T-bill rate plus 50 basis points. So it's a set amount. These days, T-bill rates are pretty decent. So that return is pretty decent. But we don't have to look back more than a few years to see when T-bill rates were close to zero. So very little investment income on the retro back in those days. And kind of coming up towards the end here, so hopefully you have lots of questions. How do you determine which option is right for you, whether it's reinsurance, a retro, or another program that the provider may have? Really, much of that should be based upon what your goals are. Is this a long-term wealth building? Is this more looking for short-term operating capital? Is you need to take into consideration the taxes, the ability to take loans. Again, basically going through those pros and cons and really deciding which one is best for you. And that's where it's so important to have a good provider that's going to work with you to sit down and talk through what are your goals. How do we want to set this up so it's best for you and what you want to achieve here in the future with this? And then with that, when looking for a provider, these are really key items you want to keep in mind from the very beginning. First, clear and transparent terms. So take a look at those agreements, read through, make sure everything is lining up with as you expect it to. Especially with the retro agreement, read through that, find out what the volume requirements are, what the tiebacks are, what the termination language would be if you stop writing at a certain volume. Also, expect from your provider, if you are in one of these programs, regular reporting and statements. So you should receive, if you're in reinsurance, typically a monthly session statement and other financials. And with a retro, it can vary. Some providers will provide monthly or quarterly statements. Others will be semi-annual. But you do want to be sure you're receiving regular statements, because the last thing you want is to receive a statement and find out your losses are high or you're not hitting the volume requirements after the fact, or too late to really do too much about it. You also want to find a company who has expertise and consultation with all the participation options. So I know at Protective here, we have a department that I'm part of that is purely for dealer participation. So hopefully, whichever company you're with, they do have the experts there, whether it be the salesperson that's coming in, the trainer, whoever it might be. Just hopefully, again, somebody there really knows the ins and outs of these programs and can tailor them to what really is right for you. And then related to that would be this last line is look for a provider that's going to give you different options. The last thing you want is to have somebody come in and say, well, we have these other options, but this is the one you want to do. Well, they need to show you why that's the one you should do. So you don't want to be put into a retro just because that's more profitable for the provider, or that's the easiest one to set up, or that one has the golden handcuffs. Again, work with your provider and go through all the terms, look at pro formas, compare how each of these is going to pay out to ultimately come to that decision. And with that, we're going to jump into some questions if we have any. If not, Mark is going to ask a few here, I believe. But I also want to point out, we have my email address up there. Please don't hesitate to reach out if there's any questions or any additional information we can provide. But with that, how are we looking, Mark? Do we get any?
So I got a handful of questions for you, and then if anybody else has got any, feel free to drop them in the Q&A. First question: any products you would recommend that dealers don't include in a retro or reinsurance program?
Yeah, that's a good question. Two of them that come to mind would be the first one being GAP. GAP right now, typically loss ratios just continue to climb year after year on those. It's more on the auto side. Really, loss ratios we're seeing on GAP when it comes to Powersports are still doing pretty well. They're not nearly as high as on the auto side, but that is one to consider if there's a way to maybe keep that out of reinsurance and put it into a retro where if there is a loss on that, it doesn't affect your reinsurance profits. But in general, what we're seeing is as more and more negative equity is rolled in, as loans get longer and longer, we're just seeing the average GAP claim has started to climb significantly. The other one I would think about would be maintenance. We do reinsure and have retros for maintenance contracts at Protective, but there are companies that can structure those in a certain way where they don't allow those into reinsurance because it's not a true insurance product. It's prepaid. When the claims are coming in, what the claims are going to be. So therefore, it's not considered insurance. But there are ways of being able to put those in there. And then the other thing with maintenance is generally they have higher loss ratios because we want them to have higher loss ratios. So the whole idea of maintenance is to drive the customer back to your dealership. So ideally, we'd have a loss ratio close to 100% on that. So there isn't a whole lot of underwriting profit left. But in general, we do see spoilage. We do see customers that won't use all of the maintenance. And therefore, there would be some underwriting profit left there and the investment income you're earning over time.
Yeah, I have a few other questions to dig deeper into maintenance, but I'll tell you the the horror story. A buddy of mine has got a large RV marine operation down on the coast, down in Texas, and about 5 or 6 years ago, when one of those big hurricanes came through, completely wiped out that program because they just had, I think it was 370 gap claims, and it had been pretty level up until that point in time, but everybody's RV got washed away, and yeah, it really did a number on their reserve fund.
Yeah, that's kind of the nature of gap is generally over time the frequency is pretty low of having a claim, but when you do have one, it could be painful in terms of how much that claim is.
So
So
you bring up maintenance plans, and I think that kind of drives a couple of other questions. But kind of the first one there is that some dealers have done an in-house maintenance program, and works good until one of two things happens. One, they go to sell the business, and then they figure out that, hey, I'm going to be on the hook for 3 or 4 more years. How do I pay, or how do I deal with this? The bigger problem I saw in my 10 years running 20 groups was that if you allow your service manager and your service writers to charge out repair orders to those in-house reserves, it almost always becomes a slush fund, and we tend to see that those programs go negative pretty quickly. So, I think the outside problem that dealers have had is that when we go out into the marketplace and we're working with a third party to fund those, is that a lot of times there's kind of restrictions that dealers don't pick up on when they sell those. It could be that it covers labor but not parts. It could be that the customer's got to come in, 100 miles before, 100 miles after the range, or they don't want to pay it. And so, it kind of seems like those relationships go sideways pretty quick on maintenance plans. So if someone is going to have a maintenance plan that they're going to try to reinsure, best practices there for what they should do.
well, from what you're saying, it sounds like obviously you want to know what the terms are of those contracts, in terms of what's going to be paid, and what time frame and such there. Um, but really, in general, doing a provider maintenance over an in-house program is it's more structured. So it's going to every customer. This is exactly what's covered, and they know that ahead of time by reading through the agreement. Um, and it's all happening through us. So the idea of a maintenance plan is not only to bring the customer back in, but also to have those upsell opportunities there. So you still continue to have those. But I'd say when it comes to reinsurance, again, they're priced so that hopefully the loss ratio is close to 100%. But knowing again that not every customer is going to use those, every single one of those, we tend to see the first three will be pretty steady, and then it kind of drops off after that. Whether it's the customer just forgot they even had it, or they had traded the unit in and forgot to cancel the contract. But there are definitely profits to be made there when it comes to reinsurance or retro with those due to the spoilage and on the investment income side.
So, I mean, let's talk about contract terms here for a second. And, having spent a lot of time in dealers across the country, a lot of times when I see F&I managers presenting an ESC, they just kind of come out of the gate with a 5 year. The reality is that, even post-pandemic, I think we're seeing that consumers are owning their products for 32 to 37 months, somewhere in there. And, with a reinsurance program, the owner, general manager are playing the long game, but our F&I managers are typically playing 2 weeks in advance. What do I do today? How's that going to impact my paycheck that I'm going to get in a couple of weeks? They're not really thinking about, well, should I be timing these contracts so that they're expiring just about the time that the consumer is going to trade that vehicle in and get something new. Or if we think that customers are traded in 3.5 years and we sell them a 3 year contract, is that a good way for the dealership to get their foot in the door and reach out to that customer and go, hey, you got 3 months left of coverage. Have you thought about buying something new? So what are your thoughts about getting F&I managers to adjust those contract terms?
Yeah, that's exactly it. Potentially, if you're trying to put the longest term possible on every unit, no matter how long they actually plan to keep it, it can skew your loss ratio. because the customer may not be using that motorcycle as the longer term is set out to show. But the big thing is you're potentially keeping somebody out of the trade-in cycle a little bit longer. So if I can certainly say there have been cases in the past with cars where I feel like, okay, it's time to trade in and get another one, but I still have a couple more years on this warranty here, so there's really no rush. So that's the last thing you want to be able to do. And you can look into, there are providers out there that will allow you to sell another service contract. So if you sell a 3-year contract on a unit and ultimately it turns out now they want to keep that unit a bit longer, there is a potential there to be able to sell them an additional coverage on top of that then. But from the reinsurance side, really the important thing is for controlling that loss ratio is that the term of the contract match with how that unit's actually going to be used.
I've seen a couple of dealers now that are big in the used segment and are actually including, at no charge, either a 6-month or 1-year used warranty, because that kind of differentiates them in the marketplace. When the customer's asking for a discount, well, hey, you got a warranty that comes with this. Nobody else is doing that. But also those used contracts tend to earn out pretty quickly. So you put $400 or $500 into your reserve fund. 6 months later, no claims. You've got all that money back again.
Yep, that's exactly it. So whether it's a 3-month contract or 6-month, 12-month, those could be just pure gold when it comes to reinsurance or retro, because they do earn out so quickly. And typically loss ratios on those are going to be very low. So as long as the dealer is reconditioning and inspecting those units before the sale, generally it's going to be pretty low chance of actually having a claim on one of those. Things do happen, and that's why we have the coverage. But generally, loss ratios on those shorter term contracts can be 20% or lower. So you're earning out very quickly. That those funds are within 6 months. Those are available surplus funds, and the loss ratios are really great on that. And the biggest thing was what you mentioned, Mark, about a way to differentiate yourself. You have that the signage and the banners there saying, that every used unit comes with this coverage, and then of course you upsell from there.
Yeah, a customer can always extend it. I mean, I don't know if you offered 6 months. I don't know, it'd be a ton of difference between that and a year. I mean, if a customer's going to have a problem, probably going to happen pretty quick. And again, you're right. If a dealer's got a good recon process, when we've gone back and analyzed that, the failure rate on used vehicles is pretty low.
Yeah. Yep. Yeah, absolutely. It's not unusual when a dealership is really on top of the reconditioning process. We can go long periods without ever seeing any claims. And there's actually like a sigh of relief when a claim does come in. Like, okay, if we need to show the IRS that this is legitimate coverage and potential, that you're going to have claims, it doesn't hurt to have one once in a while. But yeah, absolutely, that these are great products loss ratio wise, and giving the customer that peace of mind, and then you just have to know how to sell around it. And also one of the things that is great is typically if it's a limited warranty, the customer's not paying for it. It's a giveaway. So therefore the customer cannot cancel it.
Yeah.
So if, you're not going to be hit with any chargebacks or anything on any of those through the customer.
Good point. You had talked about, some dealers historically who have used Turks and Caicos or some of the other island nations, and now the tribes are coming into vogue. Do you have a preference, or are there pros and cons between either one that you see?
Tend to see it's shifted over time. We, along with most others, kind of sat back for years and said, okay, let somebody else go first with the Delaware tribe and make sure everything's legit, and that the Kansas isn't going to come in and say, you're regulated under this or that law. So we all kind of sat back, but now it's gotten to the point that it's been going on for so long. It's been proven that I'd say 75% of formations now are going through Delaware Tribe, because one of the big benefits there is the time it takes to form a company. The turnaround time, generally, once you get all your paperwork and everything into the tribe, it's not unusual to have your reinsurance company up and running within 2 weeks. Turks and Caicos used to be quite a few months. Now that they have some competition, they've shortened that up a bit. But it still does take a bit longer for that.
And I guess you like other companies are that play in this space. If somebody decided that they wanted to set up a reinsurance company with you, from kind of the time that you make that decision and sign a contract, you can warehouse those contracts as the dealer waits to get everything set up, and then you just put that pile of money in there. So they could start today, even if the corporation is not set up for a few months.
Yep, that's correct. So I'm glad you mentioned that. So even if they were to take the route of Turks and Caicos, where it might take a little bit longer, or things happen and they're figuring out what they want to name their company and who the shareholder is going to be and this and that, it can take some time to form the company then. So we do exactly like you said, we warehouse. So what we'll do is we'll have an agreement signed by the dealer saying every contract you sell after such and such date will be kept to the side. And then eventually when the company is formed, when the bank account is open, we push all of that business into that company. So you're not being punished for the period while you're forming the company or anything there. With a retro, it's immediate. The date that you sign for the retro to start is what it will start, because you're not forming anything there. But reinsurance company you would warehouse for that.
I mean, it's really no harm, no foul, because you're selling most of this on new products anyway. It's not like you're going to have any claims for 6 to 12 months. So you got some time to work through all of that.
Yep. And even if there are claims coming in during the warehouse period, that's just part of that book of business that we are warehousing. And when we then shift those contracts over to the reinsurance company, everything goes with that. Any associated claims or cancels and such would move right over with it. But you're right. Generally, it's pretty quiet in the first couple of years when the units are still under the factory.
Is Protective, are you, I think it's important for all the listeners to understand that there's kind of the insurance and the management side of that, and then there's the investment side. So at Protective, are you doing both sides of that, or will you manage the book of business and then help the dealer once they've got this investment, or you just help them get that corporation set up, and then how they invest that and what they do with that money is somebody else?
You can go both ways. So most common would be that they would have an account with an outside investor. The big three that we work with are Bank of Oklahoma, BOK Financial, Truist, and Morgan Stanley. So those three, because we have so many accounts with them, we've negotiated the fees down to where they look at our entire book of business when they decide what the fees are, rather than just an individual insurance account. But those, we have that relationship. When we do reviews with dealers, whether it be quarterly, semi-annually, of the reinsurance position, we will often ask the investment person to be on that call. So they're very active, very involved. Those three that I mentioned are great because the departments that we deal with are specific to reinsurance. So they know exactly what they're doing, as opposed to sometimes, you'll ask, can I use my local bank down the street? Generally, the answer is yes. But then we often quickly find that bank has no idea what reinsurance is, or they see offshore and they immediately, their compliance people say absolutely not and such there. So yeah, we do have strong relationships with investors out there that we introduce the dealers to, or they can go to anyone else they want to. The other option we see is what we call funds held. So what that means is Protective is physically holding all the funds, and they're similar to a retro. We pay out that 90-day T-bill rate plus 50 basis points there. So that is an option if a dealer just wants to keep it simple. Say, I don't even want to open up a bank account. I'll just leave the money with you and you can pay me interest on that. Or it can also be just they want to start off with that before filling out all the paperwork to open up a bank account, and then maybe down the line at some point do that.
Well, I should definitely point out that Brad and Paula over at Morgan Stanley have been NPDA partners since day one, and we did a webinar with them a couple of months ago where they kind of talked about the investment side. So, if anybody wants to go back and if watching me for 45 minutes isn't put you to sleep yet, then I have some more nighttime viewing that you can enjoy on our NPDA YouTube channel. So feel free to go back and just look for the one with Morgan Stanley, and they definitely talk a lot more about kind of different ways to invest your money, some accelerated schedules that are available now to where you can get out of those T-bills a little bit quicker and get into maybe some more aggressive investments that offer either quicker ways to earn your money or quicker ways to lose your money, depending on what war we're fighting on that week. But all the fun that exists there. But yeah, strongly recommend that you reach out to Brad and Paula over at Morgan Stanley. You had
Yeah.
mentioned the $2.9 million limit, and I just wanted to
Yep.
confirm that is an annual limit for the money that you can put into that account. That's not an aggregate limit, correct?
That's correct. Yeah. Yeah. It is. It resets every year. And then that's, and it is tied to the rate of inflation. So it will continue to go up. So it wasn't too many years ago that number had been 1.2 million for decades and never moved up. So we had a lot of situations back then where a dealer would have to set up multiple reinsurance companies, and then you had to be so careful about who the owners were and the shareholders of each of those companies, so there wasn't overlap and such. But now that they've raised this limit, it's pretty rare. You have to be a very, very large group to be approaching that limit. But it is an annual limit, and it's net. So any cancellations of the reserve are counted against there.
Would you say the cost to set up the reinsurance company probably $7,000 to $8,000 is kind of your initial startup cost, and then you're going to have an annual fee for tax filing and probably a little bit of paperwork and maybe a state stamp and things like that, but probably significantly less in year two?
Yeah. So year one is where you're going to have that formation cost. Protective, it's $5,000 all in for the formation and the initial capitalization. But I have seen that number vary all the way up to 15,000 for the capitalization and things. But generally, that sweet spot is between $5,000 to $10,000 there, and then the annual operating expenses can vary also again, but those tend to kind of be in that same maybe 4,000 to 8,000 per year.
And really,
a lot of that is dependent on how often they want different financial statements. So if you're a reinsurance company, if you want quarterly financial statements, the accountants are going to charge you a little bit more than if it's just an annual statement and tax filing.
you've got different dealership sizes. I mean, you've got some dealers who are really small, single line, up to, we've got 10 brands, 9 brands under our roof at Woods. Is there kind of a minimum size of how many extended service contracts a dealer is selling a month where it just doesn't make sense yet? They need to grow a little bit bigger, or they need to develop a little bit better F&I operation. Where does it make sense?
Yeah, it's one of those questions where you have to say it depends. Because everything is based upon all the reserves going in, so it can depend on what brands you have. For instance, the average reserve on a metric unit is considerably lower than if it were on Polaris or Harley Davidson. But I think in general, the number I would look for would be 10 to 15 contracts a month for a retro. And there, it's going to be dictated by the provider. With our retro, you have to have a minimum of 100 contracts per year. Okay. So less than 10 a month there. Reinsurance, generally, you're going to be looking somewhere north of 20 contracts per month. But the more, the better, because then you're going to have a little more stabilization of the loss ratio. But that's where it all comes back to. It's so important that you have a good partner with the provider that you're talking to. At an absolute minimum, you need to see a pro forma of saying, if I write at this volume and I have this loss ratio and this is my average reserve, this is what we predict your reinsurance company will look like. This is what we predict a retro would look like. So you can have those numbers directly in front of you. Because last thing you want to do is be putting an absolute minimum number of contracts into your reinsurance company, and any underwriting profits and investment income you're making are going to the accountants and the attorney. So you absolutely want to make sure that these programs are the right ones to sign up for.
So last question I'll hit you with. I know most dealers have had to negotiate at some point in time with a merchant processor for credit cards. And, the way that industry works is complex by design, because it makes it almost impossible to shop different processors and makes it easy for them to start, kind of incrementally jacking up fees. I tend to see with reinsurance and retro that dealers don't always ask all the right questions to make sure that what on the surface looks like a good deal really is a good deal. And, to me, I think that there's three fees that dealers can pay. Not going to say everybody does. You've got your per contract admin fee. So we sell an ESC. You guys are going to manage that for $100, $75, $125, whatever that number is. But then we also, with some of these programs, I've seen where the vendor comes in and they're like, yeah, we do that for $50. But then what the dealer doesn't find out is that there's a monthly fee based on the amount of money that's invested in the account. Or the other one that I've seen more recently that I think is maybe a little bit troubling is that there's a 10 or 15% per claim fee. So if you have a claim that's $1,000, then they're going to take 1150 out of your account, and $150 is the management for that claim. So how is Protective set up, and what are kind of those gotcha items that dealers should keep an eye out for?
Yeah, you hit upon the exact ones to watch for, especially that last one. Often you'll hear that called a loss adjustment expense. I can tell you, Protective, it's all about transparency. So we will tell you exactly what the admin fee is, and we'll disclose that we do not have loss adjustment expense. There are no maintenance expenses each month or each quarter or each year, these kind of things. So it's important to ask that. The way I would suggest going about this would be to say to a person who's talking to you about one of these programs is, show me on one contract exactly, I sell it for X, how much of that ends up in my reinsurance or my retro account, and then ultimately, how much of that is the profit to me. And I've even in a company I used to work for, we had a form that we would give to the dealer saying, here, have them fill this out and sign it at the bottom saying, these are the only fees, and everything is disclosed. And it was pretty rare that would be signed and sent back to the dealership there. But find out exactly what you're going into with this, because not everybody is as transparent as Protective.
Gotcha. Tony, do you have anything to add before I read my little closing notes? Didn't want you to get forgotten about over there in the corner.
No, I appreciate it. I think the only thing I would add is whoever your provider is, make sure you have regular checkups on your reinsurance position so you know what's happening, what's going in, what's coming out, and just so you're aware. Knowledge is power.
Yeah, I think kind of talking about horror stories, that I've got a big dealer group that I work with in the RV space, or used to, not anymore, that had their own reinsurance company. And it was that monthly checkup where they were going through claims that they discovered that something was wrong and what had happened. I think it was up in the Tennessee area that they had a small independent that was kind of in cahoots with one of their stores, and the F&I manager was sending copies of the contracts over to this guy. And so every couple of weeks, he was filing an AC claim on vehicles that they had sold, and just saying, hey, I replaced this $2,000, $2,500 AC and $1,000 in labor, and they were paying them. And it was only through that review that they figured out that something was wrong and were able to not only recoup some of that money, but the guy, I don't think he ever went to jail, but he got in a little bit of trouble. He's probably got a hickey on his record at this point in time.
Yeah, that's insurance fraud. So, but yeah, these are the things you pick up during these reviews. Another thing is early losses. If you find you're you're looking at a unit, and obviously, we have a major repair a week or two after they buy it, or a month after they buy it. You're going to see that in these reviews, and that's quickly going to bring that to your attention. Of I need to talk to my used car or used unit manager here, make sure we're reconditioning these and inspecting these correctly. So, yeah, it's absolutely key to have those those regular check-ins. Whether it be monthly to go through a session statement in detail, or quarterly to have a full, what we call on our side, a shareholder financial review.
Well, my gotcha question that no one is being willing to answer on camera at this point in time. And so I'm going to tell you what it is, but I'm not going to ask you the question. The question is, what brand has got the worst loss ratio? Nobody wants to say it in public. I think we all have a pretty good idea on who it is. But I will ask you, what brand has the best loss ratio? Which brand do you really see no problems with?
I would say in general, really any of the metric units. It's amazing how low the loss ratios can be on those, as opposed to I'm sure a couple of them that we're all thinking of.
Oh yeah.
We're even though our reserves are significantly higher on other brands, it's not necessarily enough still to keep that loss ratio as low as it is with the metrics. But
Yeah,
it's the typical story of it's if you have a loss ratio at a Toyota dealer versus a Dodge dealer, you're going to see some differences there, and it's the same with the Powersports side.
I don't think anybody 10 or 12 years ago would have thought that we were going to be selling $50,000 or $60,000 ATVs and UTVs. So
Yeah,
kind of crazy. Jay
yep.
Goddard raised his hand. I don't know if I can set it up where you can ask a question or not, but I did. So Jay, I set you up to where you can turn off your mute and ask a question if you'd like.
Can you hear me?
Yes, sir.
I would say this. I've been reinsuring my car dealerships and Harley stores for the past 30 years.
Mm-hmm.
And I wouldn't say that the loss ratio was based on brand. As a dealer, if you have a good reconditioning process and you hold your service department accountable, you're going to have a very successful reinsurance company. Every one of the manufacturers builds a machine that's going to break.
Mm-hmm.
It's your pre-sale inspections and your reconditioning, and you recondition it to a certified level. You can hold those loss ratios. I'm doing it in a Harley Davidson store, and my loss ratios are just below 32%.
Yeah. You're absolutely right, Jay.
So just like everything else in our wonderful business, it's processes and people that will drive successes or failures.
Yeah, but Jay, I've seen your office. You got a couple of baseball bats in the corner as well. So I'm thinking that might help keep the loss ratios down as well.
Well, I mean, everybody needs incentive.
No, you're absolutely right, and Jay, and that's kind of in the very beginning when I talked about what's in it for us is that loss ratio control. A dealer who's in one of these programs is typically going to have better controls, better processes. So therefore, we're going to see those lower loss ratios. So you're absolutely right. Absolutely, there's no reason we can't have very, very low loss ratios on all manufacturers, all products.
And I don't know how many dealers you have on this call right now or webinar, but I would just tell them, if you are not in a retro or reinsurance program, you're missing the boat.
Absolutely, it's a retro. Why not? If you qualify, sign up for it. There's no downside.
Yeah.
But just in reinsurance in general, I mean, it's dating myself here, but I remember going through 2008, and there were a lot of dealers out there that reinsurance saved them. They were able to pull some funds and keep going through that period. So yeah, absolutely. you're leaving money on the table. And
Yeah.
the providers are more than happy to keep all that underwriting profit and all that investment income. But it's a partner.
I don't know if you saw the interview with one of the Penske's the other day, but he was actually talking about he was saying something along the lines of their reinsurance company was not just a moat. It was like an armored fortress that had allowed them to weather all the ups and downs in the industry.
Yep.
Absolutely.
Yeah, absolutely.
So
like
Jay,
Jason,
thanks for chipping
definitely
in there.
On the table if you're not these.
So with that, thanks to everyone who attended today's webinar done in conjunction with another of our partners, the NPDA. Excited to announce that I'll continue to be hosting about 2 more months worth of these, and then I'm wrapping up for the year. So when I asked everybody to do this, I didn't think that 19 dealers were going to raise their hand. I thought it was going to be 3 or 4. So it's turned into something a little bit bigger than I thought, but thanks to everybody who's participated. Just as a reminder, the NPDA is here not just to support our member dealers, but also the entire industry. If you're a current member, thanks for supporting the organization. If you're not, then please consider joining. And just be aware that today our primary focus is this FTC issue that is impacting and affecting the industry and is going to attempt to, or we're really working hard to get the manufacturers to come to the table and understand that this is not just a problem for dealers, it's a problem for the industry and something we'd like to fix. So please do what you can to support our little fledgling organization. Would be much appreciated. And as with all these webinars, we will release the recording of this in a couple of days. It'll be available on the NPDA's YouTube channel, and I'll also make it available to our partners. They can share it through their channels as well. So with that, I'm going to call an end today's meeting. Hope everyone has a good afternoon and a strong finish to the week. Take care. Bye-bye.
Thank you, buddy.